30 seconds. Hey, can you hear me, Justin?
Justin, I think you're muted.
You're muted, buddy.
There we go. I was muted. Thought you got. Whoop, David's muted now.
That was on purpose.
Yeah. Oh, okay. Well, excited for the show today. Excited to get a chance to talk to you, David, and just learn a little bit more about this extremely cool topic. And hopefully we'll get some guests in here to talk with us as well, ask some questions, and we'll go from there. So how's your week been, Steve?
It's going pretty good. Is doing my thing, putting out offers. That's about it. What about you?
Yeah, pretty much the same. Talking to brokers, trying to get multifamily deals, that sort of thing. So, David, tell us a little bit about yourself.
Yeah, so I'm here out of Nashville, Tennessee. I live in Goodlettsville, which is just outside of Nashville. And my wife, Sharon, and I are one of the rare breeds these days of actually grew up from Nashville and still live here. It seems like everyone's moving from all parts of the country. But yeah, we've been here for most of our lives. We've done a little bit of traveling, but 3 kids. So full time, I work in debt elimination. I help people pay off their debts quicker and build an asset in the process. And that's going to roll right into the topic for today that we hit on. But my wife's got the much harder of the jobs between the two of us. She stays full time with our children. We've got a 7, almost 6-year-old. Those are boys. And then we've got a soon to be 3-year-old girl. So she works much harder than me. She just doesn't get any compensation for it. So, but yeah, that's a little bit about me.
Well, very cool. Yeah, I know that and my wife and you have been talking quite a lot lately. I'm not sure how far into the process we are, but I'm super excited about it from what little I know. Numbers are just not my thing, but I figure this is a topic that a lot of people tell me that they would like to know more about.
Yeah, it's funny because I had an appointment this morning. Someone was introduced to me. He works in the solar industry. His business sounds fantastic, and he said he actually looked into this about 10 years ago. Someone approached him with the topic of infinite banking, and I smiled, and I wasn't too surprised to hear it. It's actually something that's been around for quite a long time, but it's just something that most people don't have conversations about. It's not in the traditional space of the financial advisor, if you will, and so it doesn't often come up. But yeah, I'm excited to talk about it because it's something that we've started doing, and for our family, and there's so many positive things that you can get out of it.
Well, and I know that you have sort of a presentation that you do on this. I don't know, Steve, do you have any questions before we let him just sort of get into his presentation?
No, I think that would probably be the best way to go. Is what is infinite banking?
Yeah, sure. So let's do this. Is before I get into the nuts and bolts of infinite banking, the first thing that I do, any conversation that I have, and normally the appointments that I take with prospects or clients are introductions from, maybe it's a current client, maybe it's a colleague that I work with that specializes in a different area. But when I talk with people, I really like to take a minute or two to just give them a chance to kind of sit back, and rather than get, question after question and be browbeaten with questions, just for them to understand why we build models the way that we do. And I'll tell you what I mean by that. I think that the two biggest obstacles in the way of most everyone's financial goals are tax and debt. And debt is the biggest obstacle to uh, building and accumulating wealth, whereas the taxes are the biggest obstacle to distributing that wealth, if you will. And so, what I try to help with is building just a basic plan or model that is going to reduce some of what a person has to pay in taxes, particularly in the future and towards retirement, but also reducing or even eliminating, if possible, the interest that's lost on their debt. And what you find out, there's a pie chart, and I don't know how to share the pie chart in this setting, but it's easy to explain. Most people save about 10% of their lifetime income. I mean, it's, you get higher and lower, but most people for their lifetime income, they're going to save about 10%, whether it's maybe through a 401k, maybe they do it independently. But if we can reduce some of those taxes and reduce the interest lost to debt, then that 10% suddenly turns into 20 and 30 or more that is actually money going into your pocket versus going to taxes or going to the bank or the credit union on your debt.
I like
And
that.
yeah, most people love it. I ask people, it's kind of a question that answers itself, but I say, hey, as long as you're on the right side of the law and the IRS, would you rather pay as little to taxes as absolutely possible? People say, yeah, absolutely. And most people, when posed with the question, is if you ask the question, what's the one thing that if you could change would completely fix the rest of your financial picture? You get different answers, but universally, most people would say that if I didn't have any debt at all, then that would completely change my situation.
Mm.
And I think where our conversation will end up is actually in the category of investing. And it's really, and that's of course what we're working with your wife is um, even looking beyond the debt is okay, well, what if I can just leverage my cash flow in such a way that it's going to grow and earn compounding interest without any guesswork or risk, and it's accessible. And instead of borrowing from somebody else, I can use my money, pay myself back, but never lose that momentum of compounded interest. So, with that being said, is it all right with y'all if I try to share my screen, fingers crossed, and see if I can go through the?
Yeah.
Please.
I've got a slide deck I prepared. So, all right, everybody, cross your fingers and let's see what happens. All right, share screen.
And again, just for those who are watching, you're watching The Grow Giver with Stephen Crawford and Justin Hoke. And today we're talking with David Begley on the topic of infinite banking.
Okay, so can you see where it says debt free for life? How does that work?
Yeah, we got you.
And so can our
So,
viewers.
got it. So everybody can see it. Great. So either one of y'all, are you familiar with the debt snowball? Is that something that you've heard of?
I'm not.
No.
So Dave Ramsey is a guy that he back in the 90s, he really built a business empire based on getting people out of debt. And this is an elimination strategy of debt that he kind of made famous. I'm going to go through this part pretty quick. The three things that we focus on with Debt Free for Life is paying off your debts quicker, keeping your current lifestyle, and then having something to show for it so that you don't have to go back into debt and keep the cycle going. So the debt snowball, let's say we've got 3 debts here. We've got a credit card, about 6,100. We've got a student loan of about 39,000, and we've got a car loan of about 39,000. The payments are going to look like about $160 on the credit card, about $352 a month on the student loan, and about $498 on the car payment. So altogether, you're on the hook for about $1,010 a month. The traditional debt snowball says you take a look at your monthly budget and you find any extra cash. You take that extra cash and you put it to the smallest balance first, which would be the credit card here. And you do that until you pay off the credit card. Once the credit card's been paid off, you take those payments along with the extra cash and you roll it on to the next one. So you've got a little bit more money going at this point. Once the student loan's paid off, we do the same thing again. You pay off the debt, you take the payments that you're no longer on the hook for, and you pile those on top of the extra cash. And if you picture a snowball rolling downhill, it gets bigger and bigger every time you pay off a debt. Now, I'm a numbers person, so let's use an example here. So say you have $500 of extra cash in your budget. You take the 500 here. First, it's going to the credit card. So we've got an extra 500 a month until that credit card balance is paid off. Then we have 500 plus an additional $160 a month going on top of the student loan. Once the student loan's been paid, we've got 500, we've got 160 from the previous credit card. We have an additional 352 from the student loan. And the thing to really gather here is that your budget isn't changing from start to finish. The only thing that changes is where this money is going. And so you've got all this extra money going on top of the car payment, and eventually you're 100% debt free. And that's fantastic. You know, most people, that would be a game changer for their financial situation. The problem with this model, though, and I'm going to unshare here briefly, the problem with this plan is that you've just spent all of your money on getting out of debt, and you haven't saved anything for yourself. So you're in a position that as soon as you have to make a larger purchase, you have to borrow again and start that process all over again of paying and losing the interest. And that's the problem. The other issue here is every time you push money to the bank or the credit union to pay off your debts, you cannot do anything else with that money. You give up the ability to do anything else with those dollars. The banks take those same exact dollars that you just gave, and they use them 4 or 5 different ways to earn compound interest for their accounts. And that's the problem. So what do we know about compound interest? Here, let me come back over this way.
Yeah, about all I know about it is that it's a good thing.
Yeah. Okay. So let's piggyback off that. So it's a good thing. And let me see. Are you seeing the screen yet? That I'm trying to. Okay, here we go. Perfect.
Yeah, we got you.
Got it. So what do we know about compound interest? It's a good thing. Einstein has this great quote: "Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it." And unfortunately, if you're in debt, guess which one of those applies? So this is what we want to reverse. This is the process. So this is how the debt-free for life snowball looks. This is what it looks like in action. Same scenario, say we've got the same debt. The first thing that a person does with this plan is they make their minimum monthly payments. Whatever that is, that's pretty simple. Instead of putting the $500 directly onto the credit card balance, you put it into this SDIC, or this cash account. Now, the SDIC is a specially designed insurance contract. So it's an insurance contract that's going to earn cash value, and it does so in a way that has guarantees built in. It's going to earn compounding interest. Eventually, you have enough to take it out of that cash account, and pay off the credit card debt. Now, once you pay off the credit card, you take those payments, that $160 a month, and you redirect it to refill that cash account. So now we have 160 plus 500. Your money is earning interest this whole time as well. So eventually you have enough to take it out of the cash account and pay off the student loan. And once the student loans pay off, we do the same thing. We've got 500, 160 from the credit card, now an additional $352 from the student loan that we no longer have to pay. And so the bucket's going to refill quicker. We never lose, and this is so important for the infinite banking, like to understand, you never lose any of the compound interest that you've captured. And eventually here, the last step as far as the debt is to take it out of this cash account once you have enough and pay off what's left on the car loan. And the last person to pay back is yourself. And the best part about that is because the debt snowball is getting bigger and bigger, you pay yourself back very quickly here. And you've done two things at this point. The first is you have eliminated all your debt, which is just as exciting as it was before. That is a big deal for most families in our country, I would argue. But beyond just paying off your debts, you've built an asset for yourself as a means to stay out of debt. So whether you got to get a new refrigerator, you got to get a new roof on the house, a new vehicle, you want to put a down payment on an investment property, you use your money instead of going and borrowing and paying compound interest to somebody else. And this is at the end here, apples to apples, what is really the difference? Let's look at that. You don't have to do anything, obviously. You could just make a minimum payments. In this example, if that's what you did, you'd be paying until about March 2037. And if you did the traditional debt snowball, just paying extra money onto the debt directly, you pay off much quicker by March 2031, which is way better. Of course, if you look at the bottom, there's still $0. There's a goose egg in the cash account balance. And if we helped to build a plan to get you out of debt with this example using our program, you would be debt-free by around July of 2031. Even though that's a few months longer, when you look at the bottom, you can see that there's a cash account balance of about $51,000. And that is what you use to keep from having to borrow and go back into debt. Go ahead. Sorry.
Oh, okay. I got a question on that. So essentially, let me make sure I understand what you're saying is that you take the amount of money that you would spend on your car payment or whatever payment you decide to take on first. You put that payment into the cash account, and then you take the cash account and you pay the car debt with that cash account.
So I don't know if this is exactly what you just said, but whenever you're going by this plan, you make whatever the minimum monthly payments are. So like if I have to pay $350 on my auto loan, I'm going to make that payment each month. But what's happening is whatever the excess cash budget is, say 500 in this example, instead of putting that directly onto the debt to pay it off quicker, I put it into the SDIC because that's a cash account that's going to grow and earn interest. And eventually when I have enough, I take it out and I just pay off the balance of the debt. And every time I do that, I refill the cash account using the same budget as original, but we take the minimum payments for the debt that we're no longer on the hook for, and we start that snowball. And so go ahead.
So when you pull that out and you eliminate the debt on whatever is the vehicle or whatever it is, then you're making payments back into your own cash account, rebuilding it back up.
Exactly. The last step to this is just to be honest with yourself, because we're so good about paying back other people's debt. Like let's pay ourselves back, right? So, and the beauty of it though, Stephen, is that because of how the debt snowball works, all we have to do is stick to the same budget that we've been writing for months or years, depending on the example, and do it for a little while longer. And then we haven't just paid off our debt. We've got this asset. We have a cash account that, by the way, you can continue to use as a cash flow vehicle. In other words, you can keep saving to it and contributing. It's going to continue to earn compounding interest, and it is a tax-free cash account. Like the tax code 7702 explains how in the vehicle of a life insurance policy, the gains and the accumulated gains, as long as you set it up the right way, which we make sure to do, all gains are tax-free. So when we design these, we do it very, very specifically so that we can put as much as absolutely possible to the cash account. We don't really care about the insurance, to be honest with you. It's a great side benefit, but that's not what we're here for. Like, that's not why we're doing it. And we want to maximize the cash flow. So when we're out of debt, we've paid ourselves back. Even if you don't keep contributing, what's beautiful about it is the cash account will continue to grow. So unlike a savings account where a lot of investors keep cash handy because they need it, they might need it at any time to make a down payment or scoop up a property. Well, we can build these vehicles in a way that you obviously put in a monthly contribution, but you can also dump in a lump sum up front. And the way we set them up, you can have the dump in, whether it's 50,000, 100,000, 30,000, doesn't matter. That lump sum amount is available to take right back out within 2 weeks' time. So it's a very, very liquid vehicle. And to be crystal clear, because this is a question that will come up, not all of these vehicles are the same. In other words, you can build an SDIC many, many different ways. With the programs I help with, there's only a few different options that I'm looking at, because what we need is liquidity. We need early liquidity because it might be someone is using it to pay off a debt early on. Or it might be that someone wants to take money out early on to use for investment, but we need to be able to get to the money. It grows with guarantees. So we're not using guesswork. We're not depending upon market performance. And it's very tax advantaged, which is to say it's tax-free when we take the money out. And let me show one more thing, if it's okay, because I do want to really, there's some math I want to show you that is pretty strong and pretty powerful about why this is so important. Okay, here we go. Got it, share. Okay, so can you see this again here?
Yep, we got
Perfect. You. So why is this program so important? So let's take the example. This is the problem with the debt. I want to put a name and a face, or a number to it in this case. So let's say we have a $200,000 mortgage at 4.5% for 30 years. What is the effective interest cost? Effective interest cost. So we've got $200,000. We have a 30-year mortgage and a 4.5% rate. The first payment on that, if you just look at principal and interest combined, is going to be $1,013. Out of that first payment, the amount of that that's going to interest is $750. $750 out of that $1,013 is going to interest. That's an effective interest cost of 74% on day one. Now, here's a pop quiz for y'all. Do y'all know how long it would take on a 30-year loan to actually achieve a 4.5% effective interest cost in this example?
No, sir.
29 years is the unfortunate answer. It would take 29 years. That interest is compounding for the bank. And that's the problem with the debt. So that's why anytime that I start a conversation or a visit with someone, the first thing we look at is, okay, what unnecessary losses are you taking? Because let me ask you this, if somebody's 70-50% effective interest costs, the reason that's such a big problem is where on this planet could you go and take your money and get a 50% rate of return on any type of an investment or savings vehicle out there? And it's not a trick question. If y'all figure that out, I'm the first call you make.
Yeah, no, it's that. Right.
I have a picture on my phone. I sent it to a client the other day because I get a mortgage statement every month, and it's real. Like if you look at, have you ever looked at your mortgage statement, just the one that you have, and
Right.
say you've got a 3% or 2.5%, say you're very financially responsible, and you pull out your statement and you look at it and you kind of think to yourself, that does not feel like 2.5% and 3% to me when you see how much is going to interest. And yeah, that's the problem with the debt. But Justin, the other part of this, for the majority of people, the number one help is going to be to eliminate that problem. It does go a little bit deeper in some cases, and that's what we're working on with your wife, for example, because if you're an investor, if you invest in property, you may want to use, it's not that you wouldn't love to stop losing that interest, but there are the examples of an investor to where you would be better served by using this as a cash flow vehicle to push your cash into it and take it out when needed to purchase an investment property, just because you're going to make far more on the property than you would benefit by eliminating the interest. That's really the one example I know of where it makes more sense to do something, but there's a lot of that out there. And I don't know if y'all's audience, I feel like that might fit into the wheelhouse a good bit of the time. So there are times
I
where,
would think so.
so even if we're not focused on the debt first and foremost, this ultimately is a cash flow vehicle. Let me pull up an example here.
I know that's what got us really excited about this, is the idea that we can use our own money, collect interest on that money while we're using it in investments that are also bringing us interest, and just being able to sort of take from both places. It's like, but I need people like you, because I don't, numbers don't work well with me. But I mean, I gotta muscle up.
Yeah,
but.
here's a good example. This is a case that I'm working on with someone, and so there's a planned annual premium of $40,000. So if you divide that month, so they're paying monthly, but it will be equal to $40,000 a year. And there's a dump in this case of $100,000 up front. So we build it to where we can do that. We're keeping it in the guidelines we need to, so that everything's tax-free. But the way that we design these and the specific products that we choose to use, that $100,000 will be completely available after 14 days. In 14 days, this individual can take that money right back out and use it completely. Now, some people might say, well, that's great, but why would you want to do that? Well, the reason why you would want to do that is because as you pay yourself back, if you refill that bucket back up, in other words, you're going to keep the interest that would have been there the whole time.
Okay, explain that a little bit further, because I think that's
that's the exciting part right there.
So, like I kind of have like a little bit of a disconnect understanding. So what do you mean? Like, so you have this account and you're essentially, you put money in it, and are you borrowing money against it, or are you actually taking the money out?
No, you're borrowing money against it. And the key word here, Stephen, for the SDICs that we build, they have to use what's called non-direct recognition. Okay. And non-direct recognition is saying that, okay, Stephen's got, right now, he's got a cash account he's got $100,000 available to him. if Steven takes out $50,000 on a loan, well, $50,000 has been taken out on a loan, but every month and every year, the account is credited with the gains as though $100,000 was in the account.
Got it. So
That's
you
the
dropped that
very
100,000 in, you're making the gains on 100,000, whether you borrowed 50,000 against it, regardless.
exactly. That's
That's
exactly right.
awesome.
And here's the other thing too, and this is where it gets really neat, is these, you take out a loan, there is a loan rate. It's a 4% is the loan rate. It's not too good to be true, but let me explain the math. So you take out a loan, you pay 4%, but over the past 15 years, these products that we're using are giving back between 4.6 to 5.8%. So if the loan rate is 4%, and if they're going, 4, if I could speak, if they're going 4.6 to 5.8% on the return, that's effectively a 0% loan that you have or better. And what I show people in the illustrations is, let's say we've paid off debt. Let's say that's what they want to do. Eventually, you're not going to want to pay premiums to the policy, and you don't have to. What I show people is after they've stopped paying any premium. So if the annual premium or monthly is $0, if they've given the policy enough time to work, I show them money taking out and them paying themselves back. So let's say you bought a Tesla and you wanted to buy a Tesla. Say you spent $100,000 and you financed it for 72 months. The reason I like this example is because a lot of dealerships would give you 72-month 0% financing. So what I show people is what it looks like when you take that money out and you pay yourself back over a 72-month period. What's interesting is this: you will have made money on the money that you borrowed, maybe 20,000, maybe 60. It depends on the size of the cash account. But the question that I ask is, how many Teslas are you going to want to buy if you can make $20,000 on the money that you borrowed? Or sometimes it's bigger figures than that. And it sounds funny, but if you think about why are the auto dealers so happy to give people these loans? Well, this is why. This is why you can get a 72 months. I don't know about nowadays, but used to be you could get that until recently. But this is how banks make money. And if you go really, really high level, there are some big banks out there, several, that have many, many millions of dollars of assets in these cash value policies, because it's risk-free, it's predictable, it's tax advantaged. But yeah, I absolutely love it. I don't know if I answered a question there or not, but if you have any questions, I'll be happy to take them.
Yeah, I think it's pretty cool. You could you can use it to you can use that account to make down payments on assets too. I think that's pretty neat. It's a pretty neat deal.
Abel in the on the live stream is asking, what is the split that you do on the cash value life insurance?
So the way that we usually run it, Abel, is on some of the illustration software, it just has the option for minimum non-MEC. And so MEC is modified endowment contract for anybody unfamiliar with it. And so that would automatically build it in a way that we're putting as little as possible to the actual death benefit and as much as possible to the cash value growth. Now, to be honest with you, how I design mine and how I design a lot of people's, because it allows for more flexibility long term, mine is actually 50-50. So in other words, it's basically 50% to base premium and 50% to the paid up additions or flexible paid up rider. And the reason I did that, I could squeeze a little bit more out of the cash, but I like having the flexibility for, okay, a year from now, 2-3 years, my cash flow is better and I'm more profitable. I might want to put in more. And so, in other words, I've given myself room to contribute more in the future without getting into any mech trouble. So, in other words, I'm keeping it to where it's going to be tax free. It just gives me a little bit more flexibility. And I'll say this too: in the cases where we dump in 50,000, 100,000, whatever up front, those we just add on as little of a term policy as possible, because we have to show enough insurance in place to keep it in the right guidelines, right? So we build it with a very small, well, it's usually actually quite large on the death benefit, but it's as small as it can be for like a 10-year term that shows enough insurance early on to justify putting in this cash on the front end and keeping it tax free.
Now, if some of our viewers are wanting to know how they can learn more about this or maybe talk to you personally, where would they go to do that?
So, yeah, I will. Can I put something in the chat?
Yeah, absolutely.
Perfect. I'll see if I can just copy and paste this here. Fingers crossed. Okay, that looks good. So yeah, that's my information. That's my personal email. That's my website. And I'll tell you what I'll also do here is I'll put my a link to my calendar.
I'm not 100% sure if our viewers will be able to get that link to your calendar, but I can put that in the down below in the description for those who watch it in the future. Okay. And then right now I'm going to create a little slide here for those who are watching, so they can get your information.
And if you want to set up a time to talk on my Calendly page, there's an option for a 15-minute slot and a 45-minute slot. 45 minutes is a regular appointment. If you book a 15-minute slot, I'm happy to do that. It will just be more high level. We won't get into a lot of details. We might just kind of get on the same page, see if there's a way that it might benefit you, and then we could book a follow-up time from there. But now yeah, go ahead. Sorry.
That would bring up another question for me, is I know that you're in Tennessee, so you're local to where I'm at, and I'm in Tennessee too. But what if the person watching is in New York and they still call you?
So, fun fact, that's an interesting example. New York is literally the only state of residence that I cannot do business in. But, New York apparently, as I'm told, is a complicated state to do this type of business. So I'm licensed in about 18 different states, and I can get licensed in all of the other, whatever the math is, besides New York. If you have a residence in New York and you have another residence in another state, then we can do that. But besides New York, yes, absolutely. And I was going to say, I work with the company I work with is Equus Financial. I'm specific to retirement solutions, and the very narrow lane that I focus on and stay in is with our Debt Free for Life program. I work with a group called the Smart Advisor Network. The SMART is Strategic Movement Around Retirement Taxation, and that's currently who we have the debt-free software for. And the carriers, it could be any of a few carriers. Now I'm contracted with probably 20-something different carriers and financial companies. But when we're talking about these SDICs for infinite banking and paying off debt, I'm really only looking at a few because I'm looking for those very specific features that we talked about.
Yeah, and for those of you who are watching, and this is at a later point in time, look down in the description. The information that's on the screen I'll have there for you.
The last thing I was going to say, because someone that's watching this may have a question in the future, the companies that we use are not stock companies. They're mutual companies. The reason that's important is because a stock company is tied to index performance usually, which last time I looked was not 100% stable all of the time. So a mutual company, on the other hand, or a fraternal company, those are related to actual policyholders. And the companies that we work with are showing positive dividends for, a century consecutive plus. And it's a distinction to make that there's a lot of information out there on this topic. I've gone down the rabbit hole on many different YouTube channels, and you can do it a lot of wrong ways, to be very honest. But when you do it the right way, it can be such a fantastic vehicle that uh, can help you personally, can help your business, and can help your family for generations.
Mm.
Hmm.
Now, when not to open up another subject as we're sort of winding down, but um, you had mentioned that the interest rate that it is collecting can be like 4 to 5% or whatnot. Does it change or does it stay? Is it a fixed rate? How does that work?
Yeah, so it will depend upon the carrier, but for example, one of the carriers who we use, it has a guaranteed rate, so that's a contractual guarantee of 3%
Mm.
monthly. And in addition to that 3% monthly guarantee, it would also include the dividends, which those are declared annually. So what you look at is usually around like 4.5 to 5.5% altogether. That's how I explain it, and that's a pretty conservative estimate, I would say.
That's very cool. I mean, even with a lot of people out there right now, they're saving in a regular bank account, and with inflation, I mean, we're basically just paying the banks to hold our money, and so to have another option is amazing.
Yeah, no, absolutely. There's a high cost in most cases for liquidity. Liquidity can be a very expensive thing in some cases, especially now. Um, but to have a vehicle, and this isn't like a get rich quick thing. Like, even though I'm explaining how you can put in a lump sum and have it readily available, the total cash value, when you consider the monthly premium, you want to give it time to cook. You want to give it time to work. Compounding interest, when you add time into the equation, that's where the magic happens. So not a get rich quick. It's not too good to be true. It's just got to be done the right thing, or excuse me, it's got to be done the right way, and it can be beneficial on a lot of different levels.
Hmm.
Steve, do you have any more questions?
No, I mean, no, not that I can think of. I think that it's a lot of interesting information for sure. I'm definitely going to look into it more.
There's a lot
Yeah.
out there on it.
Yeah, I'm pretty excited about the idea of using it to make down payments on like properties. So that's pretty. I think it's a pretty neat idea.
Yeah.
And
No,
for those in the Gator tribe, I mean, just think about what you could do there if you're a Gator lender and you're working with
Yeah, that's something I was
chunk
thinking about
loans.
earlier. Yeah, that's something I was thinking about earlier. Yeah, if you were lending people money in small spurts like that, I mean, it could be something that your money. So essentially, like, let's talk about that for a second. So like if you were if you had like an account with like $50,000 in it, and you were going to lend somebody $20,000, now that $20,000 is making you money, and you still have $50,000 over here making you money.
right.
Yeah,
Yeah, you're
that's
credited the 50,000 with using non-direct recognition. Your account is credited as though 50,000 was there, even though you
sitting
do
in
have.
that. Yeah, sitting in that because you're borrowed against it. So so how it works is like you would have borrowed against it at a certain, and you're paying it back at whatever it is 4 or 5%. And then
Yeah,
you
yeah,
you lend out your money at 10 or 20, 10 or 12%, and you can make a lot of money doing that.
yeah.
Yeah.
And what's funny, Stephen, is uh, doesn't that sound exactly like what banks do, kind of? you know,
Yes.
I mean, it
Right.
really, when you say it in the way you just did, it really makes the term make a lot of sense, because banks lend money out. Here's what's great. We're talking about insurance companies. Now, insurance companies are state insured. Insurance company, insurance companies, the good ones, the right ones, which are the ones that we will use, they have to have way more, I'm using layman's terms, way more assets on the books to have those financial strength ratings. Banks lend out way more money than they actually have you know what I mean? So it's an interesting thing when you're just talking about safety and security. It's very interesting because the cash accounts that we're talking about here are in insurance products, and they're backed by each individual state department, and they have to jump through a lot more hoops and show a lot more financial solvency to maintain those ratings. Whereas, when the housing market crashed, people quickly realized and understood that, the banks don't necessarily have all of this money that is being lent out. So yeah, it's very interesting.
Yeah, it's crazy. It's crazy. Yeah, no, it's pretty exciting stuff. I'll definitely be putting myself on your Calendly over here. Get
Yeah,
some more.
is Calendly not the hip scheduling thing anymore?
Absolutely.
Yeah, like I think it works great though. I don't know why we would change it, but
It works well for me, but I know there's a lot
Yeah.
of other ones out there. I'm not necessarily the hip guy, so thought y'all were. That's what I was asking.
no.
Well, and again, that Calendly link for David is going to be down in the description below. So will his contact information and some more stuff. Just want to thank you, David, for coming on the show today and giving us this introduction to such an amazing concept of infinite banking and the way that it can generate wealth for us over time. And it's just thank you.
Yeah,
And
I appreciate y'all having me on. It's great to see you again, Justin, Steven. Great to meet you. So yeah, I absolutely very happy to be here.
Oh, nice to meet you too. Thanks. Appreciate it.
I think with that, we'll go ahead and wrap up. Thank you for watching The Grow Giver with Steve Crawford and Justin Hoke. Our special guest today has been David Begley, talking about infinite banking. And wow, my mind's blown. So we will see you all next week.